Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So the first thing that we want to do is open up any equities underlying in our brokerage platform. We've got UAL up at the moment. It doesn't matter which one you pick. The purpose of this step is to get a list of expiration dates available so that we can pick one to use when we're mocking up positions moving forwards. Now, all equities have the same expiration date, so it doesn't really matter. Some may have more expiration dates than others, it just depends on liquidity, but the monthly expiration dates are what we want to focus on, and they're always the same for equities. So the expiration date that we want to pick needs to be between 30 and 60 days out in time. And it also needs to be a monthly, not a weekly or a quarterly expiration date. So the only one that actually fits that criteria right now is January 17th, which is 37 days out in time. And we can take that information, 37 days, come over to our watch list and simply filter out any and all underlyings that have earnings over the next 37 days. And the reason for this is because we do not want earnings to disturb our trade. It will increase volatility, mess up our deltas, and it will ultimately have a negative effect on our P&L. And we also want to filter out anything with a low liquidity rating level. This is because we only want to be trading liquid markets so we can get in and out of positions easily, and so that we only pay tight spreads, not wide spreads. So you'll be left with a watch list. This is a futures watch list. We're not going to go over futures today. However, futures are great to use whether you've got a small or large portfolio. Very, very great ways to maximize your capital efficiency. We're just going to use this high options volume watch list. It's just a pre-made standard watch list. You can use anything that you like. And I like to order everything from high to low IVR. The reason for this is because we want to sell premium and sell contracts when volatility is high, and then we want to play the contraction of volatility back down to the mean and further below, and then exit our position. Volatility is mean reverting, and that's one of our edges when selling premium if you do it the right way, which you're going to learn how to do here. So we want to, at this point, also keep in mind what's already in our portfolio. If you're very heavy in tech stocks, you don't want to then look for another position in tech. Keep everything nice and diverse. If you want to get fancy, you can use beta weighting. You can use your correlation to the SPY, but for the most part, as long as you use common sense, you'll be fine. If you don't know what a company is or what it does, just Google it. I mean, within 10 seconds, you'll know. It's not difficult. So there's no excuse to not be diversified. This is an example portfolio, a very small portfolio, so we're not really focusing on diversity in this portfolio. We're just simply using it for example purposes, but in your actual portfolio, make sure you're diverse. So we go down the list and we see what looks well. You want to make sure that it's trading for a healthy amount of money. Make sure that the share price is pretty healthy. For example, you've got Nikola here trading at $1.58. I mean, let's have a look at Nikola. If you were to try and sell some contracts here, look at how limited our strike selection is. Your deltas, you're basically trying to trade with your hands tied behind your back. There's not really much volume, there's nothing happening here. So Nikola, you know, it's too small. We don't want to trade this. Tesla, on the other hand, trading at just under $420. For naked positions, it's probably too big for most accounts. However, for covered positions, it's great. GLD, again, for covered positions is great. We've got PLTR, Palantir. Palantir has been on an absolute tear over the past month. It's trading at $72, just over $72 a share, an IV rank of 60.7, and it's got an absolute IV level of 67.3. If we just have a look at the chart here, back in January, it was trading at about $15 a share, and now we're coming up towards the end of the year now, and it's trading comfortably at around $70 a share, over $70 a share. So congratulations and well done to anyone who is in Palantir. My good friend Henry has been, shouting from the rooftops about Palantir. So well done to anyone that took this trade. But anyway, I digress. So Palantir is trading at just over $70. So what we're going to do is come over to our list of expirations here, and we've already selected our expiration date, January 17th, 37 days out in time. And this is now the options chain, and this is what we're going to be working from. So we've got calls on the left, puts on the right. This horizontal orange bar shows you where price currently is with respect to your strikes. These numbers here are your strikes. The strikes are, it's the number on the contract basically. And your vertical orange bar here shows you the expected move of Palantir over the next 37 days. So we want to set ourselves up for a high probability of success. Anything with a probability of profit of over 50% can be considered to be high probability, but we want to be going for 80%, 90%, between 70 and 90% probability of success. So how are we going to achieve that? Well, we already know here what our expected move is, and these dotted blue lines show us a standard deviation level. So if anybody knows anything about standard deviations, you'll be able to see where we're going with this. So we want to be selling some contracts outside of the expected move, and we can use our standard deviations as a guideline. We can also use delta. So when it comes to delta, you want to be using any deltas between 15 and 20. If we look here on the call side, we've got a 19 delta at the 90 strike, which looks very nice. And on the put side, we've got a 20 delta at the 62.5 strike, which is also looking very nice indeed. So as you can see here, now we've created this green bar. This green bar shows us where our break-evens are, basically, or our profit zone, essentially. As long as price stays anywhere within this green bar, at expiration, we'll make money. And as you can see, the green bar overshadows the orange bar, which is our expected move, which is going to lead to a high probability of success. As you can see here, we've got a probability of profit of 69%. And if we wanted to get out of this position at 50% of max profit, then we've got between 80 and 85% chance of hitting that target at some point over the next 37 days. So very, very high probabilities of success. Now, as you can see here, the green bars extend past our short strikes, our contracts. The reason for this is because we collect premium upfront, which is $3.27. And that gets added onto our break-even zones, onto our break-even price, I guess you could say. So, our break even on the call side would be $90 plus 3.28, which is why our break even, this green bar, extends past our contract. And the same thing on the put side, so it would be our break even would be 62.5 minus 3.26. Now, for anybody who is very, very new, obviously at expiration, the price can only be, in a worst case scenario, the price can only be, um, on one side. The price can't basically be at 50 and at 110 at the same time, which is why we add on the premium of both contracts onto each side respectively, individually. You don't split the premium over the two contracts. You add both sets of premium that you get from both contracts onto each break-even zone on each end. That's how you work that out. Now you might be thinking $3.26, that's nothing. There is a contract multiplier of 100 on equities, so you multiply that by 100, and your actual premium that you collect up front, the cash that gets deposited into your cash balance in your brokerage account, is going to be $327. So it's this multiplied by 100. Now, in order to open this position, our broker is going to require just over 2.6k in buying power. And that is going to give us an over 10% return on capital on this position, on a naked position. That's very good. And we've got an between 70 and 85% chance of success. So very, very good and healthy numbers that we are looking at. If $2,600 is a bit too much for your portfolio, that's no problem. You can simply just buy another contract a little bit further out, $5 wide. And then again, on the put side, the same thing, $5 wide. So what we've now done is we've created a range for ourselves, right? We've got a range between our short strikes, as normal, as you can see here. But there's nothing covering our short contracts, right? Which is why we have an unlimited max loss, which is why our buying power is so high. It's based off of CVAR. So, well, not just based off of CVAR. That is CVAR, where your buying power gets calculated from. It's basically your broker making sure that you have enough money to cover the position in the worst case scenario. So that's where your buying power comes from. Your CVAR is basically what you stand to lose in the worst 5% of cases, basically. So when you buy contracts to cover your shorts, $5 wide on either side, what we've now done is we've limited our loss. We no longer have an unlimited loss potential. Our loss is now defined in, obviously we've got a very high probability of success, but in the times where we aren't successful, which will happen sometimes, and in this case it'll happen about 20% of the time, our max loss is defined to whatever the distance is between our short and long strikes, which is $5 minus the premium that we collect up front, which is $1.33, which is 3.67, and you multiply that out by 100 because of the contract multiplier, and that's how you arrive at the max loss of $364. Now, our broker knows that we have a max loss, and it is now only going to require whatever our max loss is in buying power. It no longer needs to worry about making sure we've got enough funds to cover the worst of cases, because we know what the worst case is, and it's not that bad. It's $365. So as you can see here, our CVAR has now been updated as well, because this is as bad as it can get. So this is why now our buying power requirement has been reduced. The trade-off of this is we do now have slightly lower probabilities of success because we collect less premium up front. Therefore, our break-even zones are they're no longer extended. This green bar no longer extends as far past our short strikes as what it did, because the premium that we collect is less. Therefore, our probability of success will be slightly less. But in turn, we do now have a higher return on capital. Instead of making whatever it was before over 10%, we're now looking at, whatever this is, 30+% return on capital. So very, very nice numbers, and you can absolutely play with this. You can go in a bit more aggressively, especially when you have a covered position like this. This is called an iron condor. Don't be afraid to go to the 25 delta, and collect a bit more premium, reduce your max loss, reduce your buying power requirement. You still have nice and healthy probabilities of success, but you don't need to be afraid to go to a 25, 26 delta here, as long as you keep your risk the same, $5 wide, or if you have a slightly larger account, you go $10 wide. It just depends on what size account you have. And that brings us nicely onto our next point, which is, how do you know how much buying power you should be allocating to your positions? Well, if you click the link in the description, there is a free position sizing template that we have created for everyone to use and make a copy of. The way it works is you enter in the size of your portfolio at the top. Say if it's $10,000, not $10, $10,000. And then you enter in what the current VIX level is. Let's just say if it was 21.3, it's not. I wish it was, but let's just say if it was 21.3, everything will then be automatically calculated for you. And as long as you follow this guideline and use it to form the backbone of your portfolio over the long term, you'll be absolutely fine. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general, and there's an explanation here of how everything works. So link for that is in the description. As long as you use this, you'll be absolutely fine. If you want to learn in more detail about what we do and how we do it, again, link in description. This time click on EDS Premium, get yourself signed up. Inside you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. So you can use that as inspiration, or you can simply copy us if you want. There's a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. Um, and this allows you to learn the theory and see how it's applied in practice, all in real time. If at any point you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee as well. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk free on your part. It's £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for life. The aim of EDS Premium is to, within 6 to 12 months, get you completely self-sufficient, get you to a point where you know what you're doing and you know how to do this for the rest of your life without any external help or influence. By all means, after 6 to 12 months, when you are at that stage, feel free to stay in and be part of the community, help out. Always welcome. But the goal here is not to keep you reliant on us forever. Within 6 to 12 months, you should be able to spread your wings and fly all by yourselves. So, with that being said, I will see you guys on the inside.